Welcome to The Explainer. Today, we're popping the hood on the global economy to look at its invisible engine. We're talking about the unseen, behind-the-scenes mechanics that power every single transaction, every major product launch, and basically every successful brand you interact with on a daily basis.
So, what actually makes a business run when you aren't looking? Imagine buying a physical product online right now. You click purchase and a few days later, bam, a box arrives at your front door. Now I want you to strip away the physical delivery truck. Strip away the bank interface where you typed in your credit card number. What's left? How did that transaction actually happen? That invisible space, those hidden background mechanisms, that is exactly what we are exploring today.
All right, let's dive into this. Here is our roadmap for today. First, we'll demystify what business services actually are. Then we'll check out their 6 unique features. After that, we're looking at the financial engine of banking, how we mitigate risk with insurance, and finally, the logistics of transport and warehousing.
Section 1. Demystifying Business Services, the Invisible Foundation. Marketing guru Philip Kotler puts it like this. A service is an act of performance that one party can offer to another that is essentially intangible and does not result in the ownership of anything. Honestly, that last part is absolutely key. You aren't buying a thing. You're paying for an outcome or an act of performance. It's kind of like renting a hotel room for a night instead of buying the entire building, you know?
Moving right along to Section 2, 6 unique features. This is how services fundamentally differ from physical goods.
First up, tangibility. Or, well, the lack of it. Goods are physical. You can hold a new shoe in your hand. You can inspect a smartphone on a store shelf before you buy it. But services completely lack material form. They're totally intangible. Because they can only be experienced by the receiver, service providers actually have to create trust and impact through the quality of their delivery rather than just showing you a physical object.
Next is this really fascinating concept of inseparability. A factory worker can produce a car today for you to buy, say 6 months from now, but with a service, the production and the consumption happen at the exact same time. The service provider literally has to be present when the service is delivered. You can't separate the doctor from the medical consultation or the pilot from the flight.
Then there's consistency. Goods offer standardization. A product rolling off an assembly line is completely uniform. Services, on the other hand, are notoriously inconsistent or heterogeneous. You could go to your absolute favorite restaurant, order your usual dish, and have a totally different experience just because the chef is having an off day or the waitstaff is overwhelmed. Perfect standardization is incredibly difficult when real-time human performance is part of the package. And this brilliantly illustrates how the core business services connect to form a single giant nervous system. You've got banking, insurance, warehousing, transport, and crucially, communication. Those digital pathways that allow a business to talk to its customers and suppliers instantly. Without any one of these interconnected spokes, the entire wheel of commerce just grinds to a halt. Let's dig into these core pillars a bit more. Section 3, the financial engine, banking. This is the circulatory system of commerce.
Now, what's really interesting here is that banking goes way, way beyond just being a giant vault where your money sits idle. Modern banking institutions are highly active financial engines. Yes, of course they accept deposits, but they also manage complex financial services, advance capital, and create the monetary velocity that literally keeps businesses breathing.
So, the crucial point is how commercial banks automate our daily commercial lives. They handle periodic collections, managing standing instructions to automatically collect salaries, pay out dividends, and handle things like taxes or rent without a business ever lifting a finger. Plus, large banks handle portfolio management. They're out there actively purchasing and selling securities on behalf of their clients. They aren't just storing wealth, they are actively managing and growing it in the background. Section 4. Mitigating risk. Insurance. Protecting the value.
It's pretty wild to think about the surprising variety of risk mitigation we have available today to shield our assets from unforeseen disasters. Asset and property insurance protects your car. It secures homes from theft or earthquakes, and incredibly, it even covers commercial crops and cattle for the agricultural sector. Meanwhile, personal and travel insurance is there to protect human capital, from critical health coverage for a whole family to highly specialized student travel insurance. Basically, whatever the vulnerability is, there is a service designed to absorb that risk.
Section 5. Logistics, transport, and warehousing, the muscles and regulators of supply.
Transportation is fundamentally about bridging that massive geographical gap between where a product is manufactured and where the consumer actually needs it. In textbook economics, this is known as creating place utility. Think about it.
A brand new, top-of-the-line smartphone has absolutely zero value to you if it's sitting in a manufacturing plant thousands of miles away. Transport is what actually gives that product value by putting it right in your hand. And to create this place utility, modern commerce relies on a massive, multimodal web. Beyond your traditional road, rail, air, and water networks moving freight all over the globe, businesses rely on some highly specialized methods too. We're talking massive pipelines for petroleum and natural gas, monorails, metros, and get this, even ropeways for navigating super challenging mountainous terrains.
But wait, what happens when goods reach their destination way before the consumer is actually ready to buy them? Well, that's where warehousing steps in. And it is not just about stacking boxes in a big dusty room. It's a highly strategic service that creates what we call time utility. It preserves those goods safely until the exact moment they are demanded by the market. It's kind of like a giant reservoir holding water until a town actually needs a drink.
Let's see how this actually builds across the warehousing lifecycle. Step 1 is the basic, raw storage of surplus commodities. But it definitely doesn't stop there. In Step 2, modern warehouses provide grading and packing, literally breaking bulk goods down into convenient, shelf-ready sizes for retail. And Step 3 is perhaps the most vital of all, price stabilization. By hoarding surplus and then releasing it exactly when market shortages occur, warehouses prevent wild price spikes, which keeps the whole economy balanced and predictable.
As we wrap up this explainer, I want to leave you with one final question to chew on. How would your absolute favorite brand survive without these invisible services? Think about just a single commercial transaction you make today. Without the banking to process it, the insurance to protect it, the transport to move it, the communication to coordinate it, and the warehousing to time it perfectly, that transaction simply wouldn't exist. You now see the invisible, synchronized infrastructure that makes our modern world possible. Thank you so much for learning with me today, and keep exploring the mechanics of the world around you.